Welcome to Old Fashioned Finance, the podcast that mixes cocktails and high finance. I'm your host, Jason Demland, and I am joined, as always, and in the future, by my good friend and fellow money muddler, Caleb Frankert.
Jason, can a podcast about finance be entertaining?
Not without alcohol.
Well, all right, let's mix it up. Hey, buddy.
Hey, man, how are you today?
Good. How are you?
I'm good. You got real, deadly serious. I didn't know if we're going to talk about the deep stuff that's going on, or we're just going to be like, good, everything's great.
Well, your arm's in a sling.
Let's talk about my arm being in a sling. I had previously stated on this podcast that I had shoulder ailments.
Mm-hmm.
Well, those have come to a head.
Yeah.
I had arthroscopic surgery on a slap tear in my labrum and had a Bankert procedure done for all you orthopedic surgeons out there. 3 anchors drilled right into my glenoid humeral bone.
It's gross.
Yeah, I watched a YouTube video of what goes on the inside, they pump your shoulder full of fluids.
And they pumped you full of extra, probably.
So that's something that was weird and not a normal thing that happens after a surgery. So usually they pump a bunch of fluid in there so they can see what they're doing and their camera works and lights and all that. So it's not just a bunch of bloody gore.
Yeah.
Sorry, this is a family podcast. Can't say bloody gore.
Well, you can say it, but
can't show. Oh, look at
this! it's gross enough with the saline.
Anyway, I gained 15 pounds after my surgery. And it's not because I was just pigging out.
Nice.
That's the fastest I've ever gained 15 pounds. I set a record.
From working out, right?
Yeah, I got huge. You should have seen my right arm was gigantic.
Yeah.
It was a little concerning. I called the doctor and they're like, that shouldn't be happening. And I was like, oh, I didn't think so.
Yeah, one of those, that's weird. Call us if you die. That would be really bad.
Yeah, they're like, I don't believe you. That's really what they said.
Well, I'm glad that you're on the mend, and hopefully you'll be able to throw a baseball 100 miles an hour here in the next couple of weeks.
Rookie of the Year style, I'm hoping for.
Funky butt lovin'.
And just so you all know out there, did he just say funky butt lovin'?
If you haven't seen Rookie of the Year, watch it. Watch it with your kids. It's great.
Gary Busey.
Yes, absolutely.
It's good. My swelling went down. I wanted to tell everybody that. It dropped significantly. I'm still a little puffy, but not 15 pounds puffy.
Hey, I'm 15 pounds puffy, and I don't have any excuses. So
you know what a good way to get rid of water weight is, Caleb? Drinking alcohol.
Hey, we're going to do that today. But before we do, another good news.
Oh, okay.
So if you follow the podcast, if you've listened in the past, you know about our good friend who is on the mend.
Yeah.
We can say on the mend now.
Yes, we can. He is
from COVID pneumonia.
Yeah.
It's been, 5-6 weeks that he's been in the hospital.
Yeah, it has. And by many people's definition, a miraculous recovery. But by a correct definition, not miraculous.
Well, let's not go into that.
But
it feels like a miracle.
But it's pretty freaking awesome. And low probabilities were overcome. We are so grateful.
Well, we got to go see him today.
Yeah,
which was great.
Kind of on a high.
And he was able to communicate with us. His eyes were open, not in a creepy way like the last time that we saw him.
Yeah.
So that lifted my spirits.
I got to talk with him. I mean, that's great.
I noticed on the iPod that's sitting in there that's playing some of his favorite music and things like that the Old Fashioned Finance is on there as well. So I'd like to think that he's listening to that and we're helping with the recovery.
I'd like to think that.
I'd like to think that, but it's probably not true. So that's good news. Other good news, Christmas is coming up and we're drinking Christmas cocktails. Let's dive right in, Jason.
Caleb, I'm not familiar with the type of thing I'm drinking.
This beautiful drink, look at the presentation there. It's sharp. That's a smart drink, right? This one is called a Cranberry Bourbon cocktail. You guessed it, there's cranberry and bourbon.
Oh.
But that's not all.
Okay.
So let's dive into this. Unlike a lot of the cocktails that we talk about, there's no rich history on this or anything that I can... This is a pretty good punch that somebody came up with. So,
all right.
A Couple Cooks is the website I pulled this off of. So kudos to them. The Cranberry Bourbon cocktail is comprised of, 1.5 ounces of bourbon.
All right.
An ounce of sweet or red vermouth. 2 ounces of orange juice. 1 ounce of unsweetened, make sure it's unsweetened if you're making this at home, cranberry juice.
If it's sweetened, it's probably just sweeter, though.
Well, there's a 1/2 ounce of simple syrup.
All right.
so that might be too sweet.
Never has anything been too sweet.
And then what really makes this is the rosemary sprig.
Absolutely. That's what really puts off those pine needly aromas that just make you think of a freshly cut down Christmas tree.
It really does. It looks like Christmas. It smells like Christmas. Jason, does it taste like Christmas?
I'd say yes. Yes, it does. One of the many flavors of Christmas. That rosemary and cranberry really pop through.
It really.
What kind of bourbon did you use for this?
I used Heaven Hill.
All right.
It's kind of a bottom shelf, but not a bad bourbon by any
Mixer.
means. A lower proof. Here are my impressions of this drink. So first of all, if you're looking for something fun to bring to a Christmas party, you can bring these ingredients and mix up a big punch bowl of it.
Yeah, I can see that.
This is a punch drink, right?
Yeah.
I think this would be a pretty popular drink at a Christmas party. I think this would be a winner. I think for folks that aren't used to drinking cocktails, for the most part, I think they would like this. There's plenty of sweetness. It doesn't taste like you're drinking liquor, really, in my opinion. It's there.
Yeah. There is some alcohol, but it's like a great Christmas punch.
Yeah. I think it's pretty good. My personal impressions of this, though, Jason, are, quite frankly, I put bottom shelf bourbon in here because there's a lot of stuff going on around it. In my opinion, it does get a little bit lost in there. You do know that there's bourbon in there if you taste it. But I think going with some high-proof bourbon, like a pretty high-proof bourbon in there, even like an Evan Williams bottled in bond. I guess that's not high-proof, but 100 proof. It's a little...
Hear me out.
That's 20 proof more than what's in here. I feel like that would bring up it would amp it up a little bit. It'd be a little warmer.
And when you think of Christmas, I think of spices.
Yeah.
And when you drink rye whiskey, you get a lot of those baking spices.
Yeah.
What if there was a high proof rye in here?
I think that would be a good idea, and we should experiment with that, Jason.
I think we should. I just think you get a little more. You get like a natural cinnamon heat from a high rye. I think. I like it. It's so good.
Yeah. I think I'd put it this way: if you're entertaining and you don't have a lot of cocktail drinkers or bourbon folk there, maybe stick with a low proof, maybe bottom shelf bourbon. And again, bottom shelf doesn't mean that it's going to be bad bourbon either.
Right.
By the way, no. But if you're doing this with some cocktail junkies or maybe some bourbon fans, hey, tomorrow night at bourbon night, maybe we ought to try this.
We can make a bowl
I think
of
you
it.
could. We could. I think you could get a little bit inventive. Maybe throw a high proof rye in there. Or even just a hotter whiskey, maybe a little bit. Yeah. It's good. I like it.
Either way, it's worth your time.
Yeah,
it's just fun. The rosemary, man, that's something.
It smells like we're cutting down Christmas trees in here. It really does.
With the cranberry and the bourbon, it smells. It's making me happy.
Yeah. Hey, you know what is not making me happy? Hearing the latest inflation numbers, Jason.
Oh,
yeah.
wow.
We're going to dive into the finance topic here today, which is inflation.
Yeah, today we're going to talk about inflation. It's on everybody's lips right now because it has jumped at historic rates.
Yeah.
We have had a period over the last 10 years, really since the Great Recession, of historically low
and interest rates
inflation.
were declining even leading into that.
Yeah.
So inflation rates also were kind of going in that direction. So I think we could say pretty safely 20 years of low, if no inflation, maybe.
Right. So it's back. So now it's in the news.
Yeah.
So people are talking about it. Our clients are talking about it. It's been brought up as a reason for stock market fluctuations right now. So I think it's
another
a good
reason to be scared.
Yeah. Fear leads on those headlines, right? Or there's a common turn of phrase. If it bleeds, it leads.
Wow.
Right? Fear sells.
That's new to me.
There's a Don Henley song called...
Hotel California.
No, that's a good one. I think it's Morning News. This is when he was in his solo career, so a little more 80s, a little more synthy.
Yeah. Which I could do without.
Yeah, so I wish I could... We should just play that right now.
Copyright.
Oh.
Copyright. And I'm going to take your word for it. But inflation is, honestly, our last round of appointments, I think a lot of folks had questions, and inflation was one of the topics that people wanted to talk about. What does it mean, though? Okay? So first, Jason, why don't we talk a little bit about what inflation is, and then we'll get into briefly, this isn't going to be a super deep dive or anything, but let's get into the impact that has on our listeners, on our clients, right?
Yes.
You look like you have something you want to say.
Dirty Laundry is the name of the song.
Okay.
Dirty Laundry by Don Henley. Anyway, inflation is bad news, and it would have made that song. What is inflation, Caleb?
Inflation, I think in a really a basic definition would be the cost of goods rising over time. You know, when you talk to the older generation or anybody, yeah, I remember hearing all the time, my grandpa always used to say, I remember when a candy bar was a nickel.
Yeah.
Right? So inflation can be a good thing over time if it's controlled. But essentially, I guess that's the easiest way to explain it, is it's the fact that the cost of goods goes up over time. Mm-hmm. Now, reasons for that being a good thing, wages go up over time, and all these other elements go up over time along with it typically. But generally, when you hear the word inflation, that's a bad thing, right? Because how does it impact you or your wallet directly, Jason?
It's a loss of purchasing power. The money that you have doesn't buy as much stuff, which means your money is not worth as much.
Yeah.
That's really a good way to explain it, I think.
So we've seen relatively low, if any, inflation over the last, let's say, 15 years, right? This is something that's, for probably a good portion of our listeners, something that they've never had to deal with, really. Right? Yeah,
I think for a lot of your primary earning years here, if it's been the last 20 years, you haven't really been concerned with inflation.
Right. So, and one thing I'll say for another subset of our listeners, they probably remember something called hyperinflation too.
Yeah, if you're a little bit older than Caleb and I, yeah.
You might remember a time when a mortgage was in the teens. Yes, sure, CDs were 10 or 12%, and that sounds great.
I remember back working at the bank, I know you heard it too. You'd have people coming in that just kept doing CDs over and over again. That's where a lot of their savings was because it was safe. And they would always complain. And while we were at the bank, it was the lowest CD rates of all time.
CD rates were lower than checking account rates at that point in time.
And these people are like, I remember when I could get 17% on a certificate of deposit.
You know what I always said to those folks?
Lock that in.
You said that. You say you remember, but guess what? I can tell you where you were. You were mortgaged to the gills.
Yeah.
And I understand that's why you're yelling at me about it right now, because you paid a 17% mortgage, right? And you cussed the whole way to the bank. And now that you actually have some savings that you can put into a CD, it basically costs you money to invest in a CD, right?
Yeah, that really hurt those people on both ends because they're like, finally, once I get out of debt, I'm going to invest
I'm going to get me one of those 17% CDs. Hey, Jason, if there was a 17% CD, would you do it?
Right now, as long as they would let me. Well, I mean, even if it was an 8%, right? Then that was more realistic.
Sure.
You could get those. Mm-hmm. And you should have locked that in for as long as possible. If they let you do it for 20 years, boy, in hindsight, that would have been a great move.
What's funny is nobody was locking in.
No, their rates were only going to go up.
I guess I had a funny a funny story, but it'd be too revealing as far as where I worked and the company. I won't go there. Just some funny stories about clients having an opportunity to lock in some of those rates for the long term, and they didn't because we always think that rates are going to go up, right?
Yeah.
But along with that, usually, inflation. Right? So let's talk a little bit about how inflation is measured, Jason. There's really a couple of ways.
Oh, yeah. So the number one most popular measurement of inflation is the Consumer Price Index, CPI. Mm-hmm. Anytime you're listening to the news or you're listening to some political talking head, they're going to reference CPI probably. And it's a measure of prices that most consumers purchase out of pocket. Yeah. And it does lean a lot more towards urban consumers.
Yeah, so I have in front of me from the Bureau of Labor Statistics CPI numbers, the most recent readings. Mm-hmm. Okay, so again, we talked about no to low inflation for the last 15 years. Well, all of a sudden, Jason, year over year, these numbers are from November. We have on all items considered, food, energy, other things, durable goods, 6.8% inflation year over year. So I know this sounds really simple, but what does that mean, Jason? What does 6.8% inflation mean to our listeners year over year?
It means that stuff is 6.8% more expensive than it was last year. On average,
yeah.
On average. And that does take a lot of things into consideration. Like, for example, energy prices.
Yeah.
Right now are up an extraordinary amount compared to everything.
33.3% in comparison.
So if you paid $10 for fuel, now you're paying 13, right? Is that right? 33. Something to carry the one.
I'm sorry, I didn't really.
You're paying
Carry the one.
33% more.
We did this once before, didn't we? Backing out food and energy, though, Jason, it's still 4.9%. Okay, so everything is more expensive. Now, we're not going to get political. How do things become all of a sudden, overnight, let's take energy out of it, 5% more expensive? By the way, I know a lot of people want to look at it minus food and energy, but what do you spend a lot of your money on?
That's where most of the, like, if you are, it doesn't matter how much money you make. Everyone will spend roughly the same amount on food and energy for the most part. I mean, if you have a lot more, like if you have to heat your mansion, that costs more than heating your condo. I get that, but everybody's buying that, and really less wealthy people are more impacted by inflation.
Sure.
So what was the question? The question is what's causing this?
Yeah. How is it that all of a sudden now things cost on average 6.8% more?
Well, it's complicated, Caleb. But really, this is a simple rule of economics. It's supply and demand for the most part.
Sure.
If you have too much money out there chasing a few amount of goods, you're going to get inflation. You get a price increase. That's supply and demand. That's what's his face?
I know supply and demand, but...
Goodness, who did that? He basically phrased it the way that I just phrased it. I stole it from him. And now I can't remember his name to credit him. Adam Smith invented economics, so we'll just say it was him.
More dollars chasing less goods. So let's talk about what's happened here over the last 18 months, 2 years. COVID shut everything down. We actually shut down. Production stopped, right? So what does that mean when production stops? Well, we're not making as many goods to sell, right? But then something else happened. We pumped a bunch of money into the economy.
Yeah, people didn't need to work so much. They had a bunch of money. If you were working still, you had more money than ever, probably. Personal savings rates skyrocketed.
And you couldn't spend it, by the way.
You weren't allowed to go have fun, so you sat on your money. So when you did get out there to spend your money, everyone else was also trying to buy that thing. Let's remember toilet paper.
Well, yeah. But the recipe was there. Supply was shut down. Lower supply. We pumped money into the system. More dollars chasing less goods.
Yep.
Should anybody be surprised that we're talking about 6.8% inflation? I don't think so.
No, that really seems, when you really boil it down, that seems like a simplistic explanation. Yeah. It's really what it is. Supply chain is a lot more complicated than that.
Sure.
The actual, like, we didn't even talk about the Fed and monetary policy and modern monetary
and
theory.
We won't here.
We will not. But those things all do play into inflationary measures.
Yes.
But what you just said is the simplest way to look at it. It is, I think, having the largest driving impact on why we have inflation right now.
Yeah.
Simple supply and demand, and how we got there is a debate to have some other time.
Yeah, and that debate is how do you control inflation when it gets out of control like it is, and that's where the Fed comes in and generally screws things up.
We love you, the Fed.
Raising interest rates, right? Tightening up the money supply so it's harder to go out and borrow money, right? So you're spending less money. Yeah, I mean, they've
got some measures, and our libertarian friends are cringing right now that there is a central bank at all. And
yeah, but it encourages saving rather than spending, and we're in a situation now where we're encouraging spending like crazy to get the economy hot, to get it heating up. But at some point when it overheats, we're looking at inflation. There's no ifs, ands, or buts, no ways around it. The debate comes in, as far as, well, when things get moving again, is this just temporary? Well, we printed a whole lot of money over the last 18 months. But anyway, I guess that's not the spirit of this episode.
You want to prognosticate?
No.
Is inflation transitory?
No, we're not going to get into that here because we only have 10 minutes left in this podcast.
Do you think it's going to stick around, Caleb, and for how long?
I think a lot of it depends on how much more money we spend or print.
Lawyer answer.
Depends.
It does. There are so many variables, it's hard to track. But let's go ahead and apply this to everyone's situation. I think it's really important. On this, we want to provide some value to the people that are listening and our clients that are listening. So how is inflation impacting us?
Well, let's put it this way. There's not a lot we can do about inflation, Joe and Jane consumer, right? What can we really do? Nothing. Now, how can we help ourselves in times of inflation? Well, historically speaking, I guess, we know that bank accounts aren't going to do it. CDs aren't going to do it. We just heard that, the CPI is up 6.8% year over year. Didn't even get into PCE, the personal consumption expenditure, which is typically lower, but still around 5%. But we're not even sniffing 5% at the bank CDs or anything like that, right?
Yeah.
Or government bonds or anything, and we're not going to.
Well, I think
frankly.
it's important to point out, like you settled these, but these are like combating inflation.
Yeah.
How do I protect my money? Because if it's in right now, if people have safe investments, the cash in the savings account.
Yeah.
That sort of thing.
And that's perfect, because what do people do in times like this? We get scared.
Yeah.
And we save.
Yeah.
We say, well, and
Stuff's
a lot of people
expensive.
have not
save.
spent the money that was printed.
Absolutely.
Because they're worried. So is a savings account the right place to put it, Jason?
Not during inflation. No.
Let's just say you got 0% on your bank account over the last year.
Yeah, that's
because
about the
that's about
average.
it, right? So 6.8% inflation means what? What did you accomplish with that savings account?
You lost 6.8%. It's a guaranteed loss.
FDIC insured.
You're paying.
But it's guaranteed.
Yeah.
Now, if your clients got a statement saying that we lost 6.8%, probably not real happy about that.
No. It's
Right?
a bummer. But you can see it. Inflation is like
Right.
an invisible loss.
Yes.
But it's really there.
It's the silent killer.
Yes. So I think that's important for people to realize, because we are tempted to go safe and go to cash.
Mm-hmm.
And it's the exact wrong thing to do. So what should people do? And I mean, that's not just cash either. We're talking about if you had bonds
Sure.
that have a low yield right now, they're getting hammered because rates are about to go up.
Yeah.
Your bonds are worthless and they're paying nothing.
Yeah. And we talked about this on a previous episode, but quite simply, what we're looking at here is if you have a low yielding bond and rates go up and new bonds are issued at a higher yield, for someone to come along and buy your bond, it's not very attractive when you're locked into a low rate,
You
right?
have to discount it.
So our timer just went on. We just all right, good. Want to make sure we're staying on task here. So, by the way, new format here. We're incorporating or
We're going to try.
toying with incorporating video. So these
we
are
said
going to
that
be
on a different episode,
yeah.
and it failed horribly.
Okay, that was a pretty important episode. We had a lot to talk about. So is this, but I've got that timer looking at me, right?
No, you speed it up, man.
So we got about 6 or 7 minutes to
about
kind of get
inflation
into what we
faster.
can do. Bank accounts, that's not where you want to be in times of inflation. So I have always said over time, stocks are the best hedge for inflation, right? So when we look at what the stock market's overall returns have been going back to 1914, whatever numbers you have in front of you, I don't know, 8-9%, somewhere in that range, right? So the sad thing to say is if 6.8% inflation was the norm, if that stayed, well, we're really not coming out very far ahead in a very aggressive portfolio. But does that mean that you bury your money in the backyard or put it into money market accounts? No, you can't do that. There's some other places to go. Look at what else is going on. Real estate is through the roof, right? So you got to look at some other options. I don't know, maybe real estate, farmland. Those are the types of things that in inflationary periods, the value really goes up.
Yeah, well,
right?
if you can,
because your dollar is worth less.
if you can time it right, a lot of commodities too, because those are the things
Sure.
that prices are rising on. Like we just said, energy is up 33%.
Look at fuel.
Well, if you got out ahead of it, energy was a good place to have been. The problem with that is it's trying to time an individual asset, which we never
don't do.
recommend. So for the average person out there, the best way to hedge against inflation is to be invested in the market for the long term. The market usually beats inflation over time.
Yeah.
You can get out there and get really speculative and buy gold. Everybody touts gold. When inflation pops up, gold commercials go through the roof because it's traditionally been a hedge against inflation, not because it's
But they haven't stopped over the last 15 years.
no,
right?
they still because they're like any moment now.
Yeah.
This stock market bubble is going to burst.
That's the problem with people who've been on the sidelines in gold for the last 15 years. It hasn't worked out real well.
I'll tell you what, it could be about to pay off for them though,
It could.
because inflation gold historically has done awesome in inflation.
We've covered a lot of ground since episode 2, haven't we,
sure
Jason?
have. Now we're at inflation, but gold, people like gold as an investment to diversify because it's not correlated with stocks, not correlated with bonds, which just means that it doesn't move. It's not related to them. When their prices move, gold does not care. It's its own thing. We've done a whole episode on gold about why we don't think it's a great primary investment. But in inflationary periods, it goes up. But it's just the same with a lot of commodities.
Yeah.
After you take out oil and gold and some of those things, what you're left with, the best performing assets.
Orange juice. Oh, sorry.
Once you take those out,
Trading places.
you're like, oh, orange juice. This is good in here in this drink. Now, by the way, I didn't know there was orange juice in it, and it surprised me when you said it. And I was like, oh, definitely orange juice. I taste it.
Yeah.
Once you take these commodities out, stocks. And diversifying in stocks.
Stonks?
Stocks.
Oh, okay.
Growth stocks, high quality stocks like blue
Growth
chip
stock
stocks.
mutual funds.
Yes, they do well in inflationary periods. And the great thing is they also do well over non-inflationary periods.
Like
and
the last
over
15 years.
Yeah, and over the long term anyway. That's usually where I recommend. Now, your situation may be fact dependent and blah, blah, blah. But
It's not time for the disclosures yet.
sorry. Usually that's a good place to go. But I think it's an interesting psychological
But also
impact that
never
people
with all
go
of your
safe.
assets. None of these things that we've ever talked about have we said, yep, no, that's where you need to go. Gold, all of it.
100%.
Now.
Yes, mortgage your house, buy gold is something we have never said.
Never.
And never
Or
will.
will. Right.
That's right.
Anything else important here in the next 3 or 4 minutes, Jason, that we should cover?
Let's go ahead and distill it down for our listeners,
Let's.
Caleb. Inflation.
It's real.
It's here, and it may be sticking around. I think that it is realistic to say it's going to be a lot more of a factor than it has been in the last 20 years.
Which has been nil.
Yeah.
So it's exponentially going to be more of a problem now.
So what are some of the results we can see of being in an inflationary period now? What can people expect to experience?
Paying more for the same thing, grumbling when you leave the grocery
Milk
store.
being more expensive, bread being more expensive, your fuel being more expensive. Yeah.
Your wages probably not.
I wish. If you're on Social Security, you're about to get a raise for the first time in a long time. And a
However, if you
significant
look at
one.
your Medicare premiums too, I'm not,
The government giveth and the government taketh away.
Oh, is it 15%?
Doesn't it depend on your income?
Yeah, but
It's not good, folks.
I think on average 15%,
getting pricey out
16%.
there.
It's not getting any cheaper anytime soon. Now, there is a chance that it cools down a little bit, right? There's a lot of talk that this is kind of just, we're getting things rolling again, and once we get things rolling again, we'll be okay. But I don't know. We printed a whole lot of money over the last 18 months, Jason. So, sorry. I know we're distilling it down.
Distill it down, Caleb. Okay, so that's what people can expect to have happen. What can people do about it?
Don't sit on too much cash.
Yeah.
I mean, again, your initial response to this is, I don't know, things are going to get scary out there. Let's start hoarding cash. If you want to safely, effectively, insuredly lose money, then stick your money in a bank account.
That's right.
Or a coffee can or under your mattress, but your purchasing power is suffering every year. Hey, a couple of years of 6.8%, 6.8%. Remember the compounding episode?
Compound losses.
Works against you too, right?
Yeah, I think this period, people want to go safe. I would say having cash is good. We preach the same thing every episode, so I'm tying this into the inflation episode, and it's really the hierarchy of savings. It's also how much cash is too much. Remember the cash episode? You need cash for emergencies. You need cash for sinking funds. There are things that cash is good for, but just having it as an investment is a pretty bad idea usually.
Yeah, and if you're a long-term saver, investor, and you're planning for retirement, let's be quite honest here. The game plan doesn't change.
That's right. You got more than 10 years. We got a boring, same recipe to sell you.
Our advice is going to be pretty boring. So, all right. Well, I think that was a fun show. I think it's about time to close out the tab, wouldn't you say?
Yeah, let's do it.
All right. Thanks for having a drink with us this week, folks. It's time to close out the tab. If you have a question or a topic you want addressed on the Old Fashioned Finance podcast, be sure to email us at speakeasy@oldfashionedfinance.com. We'd love to hear from you. Don't forget to share the show with someone you love or just someone who needs a little money muddling themselves. You can stay up to date with all of the latest action by following us on Facebook and Instagram. Old Fashioned Finance is brought to you by Blue Jay Financial Group. That's bluejayfge.com and produced by Podastery Studios. We've been your hosts, Jason and Caleb. Cheers.
Cheers. Blue Jay Financial Group, LLC, Blue Jay, is a registered investment advisor registered with the state of Ohio. Registration does not imply a certain level of skill or training. The presence of this advertisement on this podcast shall not be directly or indirectly interpreted as a solicitation of investment advisory services to persons of another jurisdiction, unless otherwise permitted by statute. Follow-up or individualized responses to consumers in a particular state by Blue Jay in the rendering of personalized investment advice for compensation shall not be made without first complying with jurisdiction requirements or pursuant to an applicable state exemption. All verbal and written content on this presentation is for information purposes only. Opinions expressed herein are solely those of Blue Jay, unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by our firm as to other parties' informational accuracy or completeness. All information or ideas provided should be discussed in detail with an advisor, accountant, or legal counsel prior to implementation.